Hello to another exciting homework chapter in Accounting 2301. Bring you the awesome questions for Chapter 7, dealing with accounts receivable and notes receivable, with your awesome host, Professor Naragon. Hopefully y'all doing all great. Here, again, we're in Connect. We're going to go ahead and start with Chapter 7. Like I said, this one is all about accounts receivable and notes receivable. And again, we start off with the regular videos. So let's go through all those. Click, click, click. So here we go. Question 6. Okay. So starting off with question 6, this one immediately tells you to go ahead and deal with the direct write-off method. So if we look back at your notes, we'll find out the direct write-off method, again, only affects really bad debt expense. And it happens when we know the account is uncollectible. So with our company right here, the James Bond movie company Solstice determines on October 1st that it cannot collect $55,000 of its accounts receivable from its customer P. Moore, and applied the direct write-off method to record the loss of October 1st. Okay, so with this, is always going to be bad debt expense. That's going to get debit, and it will be wherever accounts receivable. That's fine. Here we go. Accounts receivable P. Moore. Now remember, Chapter 7, Chapter 8 only deals with accounts receivable and assets. So we should not have anything to deal with accounts payable. So with this one, we put in whatever number you got. For me, it's 55,000. And again, always check my work. These are homework questions, so you can check to make sure everything's correct. So once it's actually correct, move on. So P. Moore is back with us. Apparently he really has to use the bathroom or something because he has to pee more. Okay, sorry, I had to do the joke. Anyway, so now it's recovering a bad debt. Now we use the direct write-off in question 6. Here we're going to basically, he actually paid us back. So he hit the lotto, paid us back, and this time you're going to notice it's a different amount than question 6, because again it does reconcile through. But it did determine that on October 1st that could not collect $56,000 and receivable from P. Moore. On October 30th, P. Moore decides to somehow pay his account. Again, he probably won the lotto. If he did, hopefully he shares the wealth more to us too. But so we now have to reinstate the account. When we reinstate on a direct write-off, when we've already basically written it off, so we did this journal entry to write it off, all you have to do, the first one to reinstate, is a reverse of that entry. So we reestablish his receivable to us and remove the little deduction that we get, the expense, and put it in. Okay, so again, the direct write-off method is probably the easiest of the methods. Okay, it just messes with bad debt expense right away. Doesn't do anything else. Everything flows through it. On question 2, we record the cash received. Cash received is still the same journal entry we've done in prior chapters. It's a cash, and then find the account receivable for P. Moore. Now watch out, you may have multiple accounts receivable, so always make sure you get the right customer. Okay? Don't want to charge another customer their amount. Okay? So, again, check you did work, and everything is good. So, I mean, that was already the process with direct write-off. So, the next few questions are probably going to be dealing with the allowance method. Now, remember this with the allowance method. It's going to introduce the account allowance for doubtful accounts, or basically ADA. Okay? So, let's start with this. Gomez Corp uses the allowance method to account for uncollectibles. On January 31st, it wrote off an 1,700 account of a customer, C. Green. They didn't work on their names. These are good pun names. So, we're dealing with C. Green. Good color. On March 9th, it receives a 1,200 payment from Green. And prepare a journal entry for January 31st and March 9th. Assume no additional money is expected from Green. Now again, you do have your hint button over here if it helps you. But for us, let's go through. So we're doing the allowance for doubtful accounts. So it's going to look similar to the way question 6 is when we write something off. Okay, so going back to question 6, it's going to look something like this journal entry. But since it's the allowance method, we put ADA right here where bad debt expense is. Okay? The allowance one is the one that's the flow through, not bad debt expense. The only time we use bad debt expense in the allowance methods is to set up the allowance account. So again, make sure you hit the accounts receivable, not the payable. Remember, they owe us. We're forgiving that. So he had 1,700. 1,700. Okay. So there we go. We got that one. Let's move on to number 2. Okay. So number 2, we now get to reinstate. So make sure, again, it's going to basically be a reversal of this account. So all that happens is that the accounts are switched now. So accounts receivable and allowance for doubtful accounts. And it's going to be for the same amount of 1,700. Alright. So those are the two. Notice that they look pretty much the same from question 6 and question 7. The only thing we're adding instead of bad debt expense is that allowance for doubtful accounts. Now, number 3, we again are going to record the cash in AR because he did pay on it, but always be careful. Watch how much on this question he paid. Okay. Alright. So, I feel like I got everything in, but there is something a little bit odd with this. Okay. If we just went off of this, that's nice and fine and dandy. I want to tell you this. With question 2, when we're doing prepare the journal entry, it's going to assume no additional money is expected. When we assume this, we cannot have the complete reversal. We can't put 1,700 on our books because we don't know if he's going to actually pay. This one's actually going to be his cost. It's one of those weird things that when we do assume that no additional money is, we have to put about the amount that he actually receives or that he pays us. So, hit check my work, and that's correct. You're going to find out a common mistake on this question was the one I just showed you, where you have to watch out on the amounts. Again, we're not expecting to get any more money from him. He paid us $1,200. That's the amount that we actually want to redeem back, or basically bring back, recitate, or however you want to put it, reinstate, not the 1700. Okay, so don't get confused on that part. All right. Question 9. Now we get the percentage of sales method. Okay, Warner Company year-end unadjusted trial balance shows accounts receivable of $105,000, allowance for doubtful accounts of $660,000, and sales of $340,000. Uncollectible are estimated to be at 0.5% of sales. Whoa, that's a really strange percentage. Alright, so when we're dealing with the percentage of sales up here, remember this. This is going to be the bucket method, where we just add to our account. So to start off, we're setting up, so we need the journal entries. So it's going to be bad debt expense and our allowance for doubtful accounts. Again, when we're dealing with any of these allowance methods, this is the only time that we have bad debt expense, is when we set it up. Direct write-off has it, that's the one that it goes through, but here's the only time we have it. Alright, so to calculate this, we're going to take the 340,000 and times it by this percentage. So let's go to our calculator. There's our 340,000. Now remember, it was 0.5%. So when we convert it to actual decimal, you have to add on a couple of zeros there. Okay, so it's really 0.5% is 0.005. Okay, enter. We expect about 1,700 as the amount. So 1,700, or not 1,700, 1,700. Yeah, 1,700. Yeah, I'm saying it correctly. Always hit check my work and everything's good. The problem here, again, one, after you know your journal entry, make sure you do the multiplication of 0.5%. And again, do not times by 0.5. That'd be a large number to ever think that half of it's going to be uncollectible. So remember, convert this to decimal and times it by your sales. Okay. Question number 10. Okay, on August 2nd, Junco receives a 7,390-day note, 90-day 12% note from customer Ryan Albany as payment on his 7,300 account. Oh, he paid a note with the account, or paid the account with the note. Okay, fun stuff. Compute the maturity date for the above note. Alright, so since it's a 90-day note, of course we can go August to October, or to September, October, November, and your automatic claim will be November 2nd. Watch out for that. First off, you have a couple of months with 31. Okay, so this is a 90-day note. So it can't be November 2nd. And right now, I mean, you're looking at August 2nd, but August has 31. October has 31. So I want to figure it's either October 31 or October 30th. If you have to, pop out a calendar. Just count how many days. And if you have to, just click one, hit check my work, and you can always find it. It's multiple choice. You can select each one. But I would strongly encourage to actually be able to count the days. Here, I know if I didn't count the 31s, November 2nd is probably going to be the one that you're going to pick because it's 3 months away. Right, just remember there's two 31s. So it does fall back to October 31st. Alright, let's do the second part. Alright, prepare June's journal entry for August 2nd. Record receipt of note on account. This is establishing the note itself. Well, since we know this is a note receivable, we will have note receivable R Albany, and it's going to be for the amount that it is. Okay, so 7,300. Alright, now he actually did it for accounts. So he paid his account of 7,300. So he basically paid a note that we're expected to receive, still the money, now with interest, and paid off his account. Again, note on account. You're going to, this is basically the only time I think you're going to see it in this class is on the homework. But just realize what it is saying, how it's saying the transaction. So, with that, just watch out. Again, read, notes on account. So all we're doing is paying our account with the note. Most of the time that's not going to happen, but it can happen. This is a good way to just get a little extra money from somebody, especially from Art Albany. So question 11. On August 2nd, Juneco receives a 6,190-day 12.5% note. Again from Ryan Albany. We like Ryan Albany. He likes to pay his accounts with notes. We always get interest from him. Okay? So, this one, we actually have to record the cash and the note plus interest. Okay, so fun stuff here. First off, we're dealing with the cash. We gotta find our actual interest in this. So we're going to use this formula again. We're going to take the principal. Principal note is 6,100. 6,100. And you're going to times it by the interest of 12.5. So 0.125. And then we're going to times it and put this in parentheses. 90 divided by 360. Okay. Again, we don't do 365. We only do 360. Okay. So this says the total interest is $190.63. Remember, this is money. We always round to the nearest hundredth. Okay, so always 2 decimal places. So let's see what it says. Oh, round your answer to the nearest whole dollar. So since this is 6, it's greater than 5, or basically it's 5 or above. This is actually 191. So let's see if we got everything going. First off, let's put your journal entry together. We know we received cash. We don't know exactly the amount yet. I mean, we can basically figure it out. But we're going to keep that a little bit alone, because this is the process that goes. Next is your note. So, note receivable. And it's always going to be the principal. Okay? So, never forget, just put the principal. And it's going to be a credit. They no longer owe us that note. Next is interest. And this is always going to be a revenue. Receivable is actually what happens if it goes past December 31st. Okay? So interest revenue. And that's going to be that 191 that we calculated. Okay? So once you have those two numbers, easiest thing, just add them together and that will get you your cash. So we're looking at 6,291. So let's see if all of our math came out right. Yep, good to go. So again, this formula is going to help. Principal times interest times however many days divided by 360. Okay? You're probably going to see me reference that a couple more times. Okay? Question 12. Looks like we're looking at percentage of sales again and write-off. Sometimes the little headers help out. But at year-end, December 31st, Chan Company estimates its bad debts is 0.3% of its annual credit sales of $818,000. Chan records its bad debt expense for the estimate. On the following February 1st, Chan decides that the $409 account of P Park is uncollectible and writes it off as a bad debt. On June 5th, Park ends up paying off the loan. Always when we write it off, seems like they pay it off. We need to write off more bad debts. Get more money. So first, we record the estimate bad debt expense. So again, this is our setup of our allowance account. So bad debt expense, allowance for doubtful accounts, and we're going to do the same thing. Take how much our sales was, which was $818,000, and times it by 0.3%, which in decimal form is 0.003. Okay, so we're looking at $2,454. So again, the first time around, I would probably suggest to go ahead and always check your work as you're going through the journal entries, because it does help out. And again, we're not adjusting at all the allowance of doubtful accounts when it's percentage of sales. When it's percentage of AR or analysis of AR, that's when we actually adjust allowance for doubtful accounts. So as long as it's not dealing with AR, we're perfectly fine. Okay, so we wrote off P Park. So after we set up this account, allowance for doubtful accounts, we run everything through this account. Okay, we do not mess with bad debt anymore. This is only through these allowance methods. So again, we wrote it off. So that's going to be allowance for doubtful accounts for, looks like 409. And then we find our customer account. So account receivable P Park for 409. Okay. Number 3, we reinstate. So it's going to be basically a rehash. He pays off the entire amount. So it's also going to be the entire amount for it. Not like the other one that he only paid partial. So again, it's a flip of writing it off. So it's going to always be the account receivable and whoever it's to, and allowance for doubtful accounts when we're using the allowance method. This time for the whole amount. And now we do our last one. Record basically the payment. So always our cash and accounts receivable. Of 409 and 409. Okay. So again, if I hit check my work, I should see all green. Means everything's good to go. So again, as you see here, this is our setup account. Then here's our write-off. Our reinstatement is basically a reverse of this account. Okay, especially if they pay everything off. So it should be exactly the same number. And then the last one is always receiving the cash. Alright. Question 13. Alright, so this one brings in percent of accounts receivable. So since this is percent of accounts receivable, we're going to have an adjustment. Anytime it deals with accounts receivable, it's an adjustment to allowance for doubtful accounts. So let's see what happens here. At Each calendar year, Mazie Supply Co. uses the percentage of accounts receivable method to estimate the bad debt. On December 31st, 2017, it has an outstanding account receivable of $113,000. Woo! That's a lot of money that people still owe us. And it estimates that 2% will be uncollectible. Eek. So prepare the adjusting entry to record bad debt expense for year 2017 under the assumption that allowance for doubtful accounts has 1. A credit balance, and B, a debit balance. Okay, so let's look at this. I'm going to bring out my little paper and I'm going to make a T-chart, okay? Because this is going to help me basically start off. So, this is my 88, okay? Alright. So we're going to start it off. We know our ending balance is going to be 113,000 times this 2% because we're looking at percent of accounts receivable. So let's get our calculator to find the ending 88. This is how much it should be. So times it by 0.02 since it was 2%. And we find out that it's going to be 2260. Okay? So, allowance for debit accounts increases on the credit side and decreases on the debit. So here, according to our calculator, it should actually end up at 2260. Let me make sure I did that right. Yeah, 2260. Alright, so because it's a positive amount, we know it has a balance. It's going to be on the credit side since that's the way that it actually increases. So it's going to have us have first 1,921 credit balance. So if I have my T-chart, I know it originally starts with this 1921. Alright, so from here, I notice that my ending is greater, so that means it had an increase from here to here. So really, we're finding the missing credit that added on. Because of this, all I have to do is take this amount and subtract it from 1921. So that means I have $339 that I need to put in, and that would actually increase it to 2260. So let's do the journal entry. First off, this is a setup of bad debt expense and allowance for doubtful accounts. Again, it's a setup. Just all we have to do is adjust to make sure it makes to that amount. So 339, 339. Yep. And let's check. Yep. Everything's good. So let's do it with the other scenario. Alright. So, question 2. Okay. Now we're dealing with a 565 debt. So let's look at that. This is gone. So, using the same chart, sometimes it may help you just to use the same and erase this part so you can see what's going on again, or just make another chart. Works the same way. Okay, so again, it said 565 and it has a current debit, so it has 565 over here. Okay, so so starting at 2,260, we still have to meet this goal. So it's still going to be a credit over here. But notice that we're starting in the hole of 565. So whenever it's a debt balance, and we're trying to find this missing amount, knowing that it's a credit balance, all we have to do is add the two numbers. Okay, so 2260 plus that 556, 565, oops, almost had that transparency error, says the adjustment has to be $2,825. So again, same thing, bad debt expense, allowance for doubtful accounts, and 2825. 2825. And of course, I always hit check my work. Boom, everything's good. So again, T account's going to help to actually show you what's going on, so you can make the option. It is always going to be a credit. So, well, always be a credit, and this is really what we're finding the amount for. I highly doubt that you're going to have a negative number at the end of ADA. Okay? So, let's head to question 14. Question 14 is again an allowance method, but it's dealing with age of receivables. So this could end up being a little bit fun. Okay, so daily company estimates uncollectible accounts using an allowance method at December 31st. It prepares the following aging of receivable analysis. So we have our chart. We know how much to kind of predict that's going to be uncollectible as time goes. Again, when a debt goes on for too long, there's a higher chance that we're probably not going to see the money. So you want to collect probably before 60 days is up. At least before 90. Right? So our instructions go: complete the below table to calculate the estimate balance for ADA. Prepare the adjusting entry to record bad debt expense using a credit balance and debt balance. So again, bringing back the T-chart. So I'm just going to go File, New, and we're going to go ahead and rewrite the T-chart because we know we're going to have it. So ADA. Alright. So with this, let's start off with Part A. Part A is basically taking what's up here and putting in this chart. So not due. Well, 0 days is technically not due. So 404, 123, and then put in your percentage. And Connect is going to calculate for you. So let's keep going with this. $31 to $60, and that was 7%. 26,000 had 9%, and then over 90, you got 38,000 with 12. Okay, so is this a credit or a debit? Since it's positive, it's going to be a credit balance for allowance for doubtful accounts. Okay, so we're going to look at 26,020. So again, 26,020. Okay, and our goal is basically again to find the missing credit. Okay, so now let's move to B and C. Again, if you just feel uncomfortable, always hit check my work, and boom, there's everything there. Again, I seriously doubt you're going to have debit. You're probably not going to have a negative unless the company's having an extremely amount of loss, which seems highly unlikely. Alright, so Part B, now we have to record the estimate. Okay, again, since this is a setup, no matter which way it is, still bad debt expense and allowance for doubtful accounts. So again, this is a credit balance. So again, on my chart, I know it started out with 4,400. Yeah. So again, I'm going to be looking for the missing credit. So again, if it's on the credit side on your T-chart, if it's a credit and we already know the balance, it's just subtraction going on here. So 26,020 minus 4,400 says that we have to make an adjustment of 21,620. Okay. Okay. So there's that one. 2. Same journal entry. Bad debt expense and allowance for doubtful accounts. Okay. And again, if I look at the paint and let's just move this out as best as we can. Doesn't have to be perfect. Okay. So, and we actually start now with a 900 debit. Our goal is still to reach this 26,020. All we do is add the two numbers. Since this one's a little bit easier on the adding, it's going to be 26,920. Remember, our main goal is to reach whatever the accounts receivable allowance that we figure out balance is going to be. And it's always going to be credit. So we're just going to make an adjustment. It has to reach the goal. So again, once we hit check my work, there's everything there. Again, you can switch between the two and make sure everything's correct. And again, we always love answers complete and correct. Alright, so last problem. Okay, so again, looks like another aging account receivable report. So we're doing with an estimate. So allowance for doubtful accounts. And we're going to go Jaden Company has credit sales of $2,500,000 for year 2017. On December 31st, 2017, company allowance for doubtful accounts has an unadjusted credit balance of $13,540. Okay, and they prepare their schedule and so forth and so on. So this one, all we gotta do is fill out the little chart. Yay! So I don't even have to worry about any of this info this time around. And most likely this is going to be a credit. So let's put in the amount. 500,000 times 0.8. And they're going to make you do the calculation. So let's go ahead and do the calculation real quick. Well, add a little extra 0. Times since it's 0.8, add 2 zeros. And 4 grand. Again, connects adding that up, and it's going to do the rest for us. So 200,000 times 1.55, 40,000 times 6.05, and 20,000 times 30.5. And last but not least, 4,000 times 63. So again, as you see this, it's going to be a positive amount, so it's going to be a credit. And finally hit check my work. Okay, that's it for number 7, chapter 7 homework. Basically going through all the questions right now. So if you have any questions, any comments, any feedback, please put them in the comments below. I am more than welcome to actually answer these and help y'all out the best as possible. Okay? I look forward to seeing you on another exciting episode of Homework for Accounting 2301 with your host, Professor Narragon.